Small investors are complaining that effectively big boys got an advantage in Facebook's IPO. The sour grapes they lost because we now know, in fact, that Facebook was on the phone with Wall Street analysts telling them, hey guys, it doesn't look as good as we thought it did a couple weeks ago. And they took down their numbers. I mean, is this an example of the small guy losing? Or, David, tell me, Ryan, what do you guys think?
Well, you know, in my piece today, I argue that you know, a lot of the numbers that these analysts used to make their calls was public information anyway, because the company had reported first quarter results that showed revenues that were down, profits were down, that momentum was slowing, and you know, do you need a Wall Street firm to tell you that a house is on fire when you can see the flames and smoke by yourself? That would be my argument.
Ryan, meanwhile, Wall Street, Morgan Stanley in particular, made a fair amount of money on this offering. Can you explain the details, really, kind of the plumbing of how there's this over-allotment, right? They ended up selling extra shares and then buying some back at a lower price?
Right, yeah. So they got, I think, they put 484 million shares into the market. And they bought 421, making them short about 63 million. And they used that to kind of stabilize in the first day, you know, buying shares out of the market against that credit.
Back effectively to
reducing
cover
supply.
The short that they had created for themselves.
Creating a floor where they would kind of suck out the people who are nervous and selling at any price, kind of, you know, keep the price above the issue of $38. And then, you know, come Monday, we're told that they went back into the market and started buying at a lower price. Basically leaving that, you know, say if they bought at 32, leaving $6 in their pocket for every share.
Right, so if you're net short at 38, I guess, and you're buying back shares below 38, then you're obviously making the spread. So that worked out for Morgan Stanley, I guess, if that's what I'm understanding.
Yeah. Our sources tell us them and the other underwriters are in line to get about $100 million profit, which is, you know, everything's magnified in this because of the size. It's not unusual. The over allotment is in almost every IPO. But in this case, you know, everything's magnified by the size.
And I think that's the point. And I think we need to make a distinction in that, you know, when we're talking about the information that was given out to analysts, that's a separate issue from the decision to, or Morgan Stanley and underwriters stepping in to support the stock.
Sure.
Which is a common practice on a stock that is struggling in an IPO. It doesn't happen that often, but when stocks are
that's what the over-allotment, theoretically, I guess, is there for.
And Ryan is exactly right in that, you know, the reason that we're talking about this enormous number, $100 million, that looks like, oh, what did Morgan Stanley do to make an extra $100 million on this, was simply because the size of this IPO was so huge at about $15, $16 billion.
Speaking of standard IPO practice, that's another thing that's coming out with respect to the first part of our discussion. Wall Street analysts are a part of the IPO process. They're talking to management and not necessarily sharing their research with the wider world, of course. That's normal, right?
Yeah, well, it is.
And so in this case, in this case, when you have an example of, I guess, those Wall Street analysts taking down their numbers, I mean, do smaller investors really have a complaint that it's unfair that, say, Capri and Fidelity and these guys knew, well, hey, the numbers are coming down, we're not going to buy it, we're not going to chase it up at 38.
I think if there is a specific, and it's hard to sort of prove these kinds of things, but if there was a specific decision on the part of the underwriters and their analysts to give specific information, give a warning to large investors just in the hours before this IPO, as opposed to regular investors who are about to buy in without this information, I think that, you know, underwriters do have a fiduciary duty to all investors who are going to be buying in, and so I think that there is the potential for, you know, going back and saying, hey, you did something wrong here, and you need to make it right.
Potentially more regulation. I mean, who knows if we'll see more regulation now? It's already such a highly regulated process, IPO underwriting. And let's get a quick check of Facebook's chart here. I think it's up, yes, in pre-market trading. And while we got it, we actually, in Australia, there's a bookmaker that's saying, you know what, it's going to end above $38. We're going to give you 5-to-1 odds. So I guess I'm not a betting man, but I guess that means you can make what $10 for $2 bet. Your leverage there is a lot better than if you're buying the stock here, 32.
I you know, I've always thought that the stock market is the best odds making.
Am I doing that math right?
Book out there, and so if people are paying $32 a share for it right now, or 33, then that's where they think it's going to be. I mean, that's where the interest is. So, 5 to 1 odds. Maybe you take that.